Welcome, Matthew. Matthew Lipman is a CPA. He is from Montreal, Quebec, has been in business for the last 10 plus years, and he specialized also working, giving advice to real estate investors, especially in Canada. Taxation is a very, very complex matter, by the way. An average Canadian will pay about 45% of their income toward the taxes. Yikes! And this is the highest portion of the money goes in toward the taxman from the day you are born to the day till the day you die, and there's something called capital gain. So for enlighten us, one of the best things we're going to talk about from Matthew, we're going to ask him the most complex question. That question is about the taxes on flipping properties. Matthew, can you please enlighten us what is the stand for CRA?
Thank you for having me, Nav. It's really a pleasure to be with you and your group. So yes, the CRA has come in and made some adjustments more recently because of the government pressure and the political climate. They're targeting, the real estate industry, and more recently they've come in and made put in additional red tape to make our lives more complicated as real estate investors and property managers. So it's really important to make sure that you have a plan from the get-go, that you sit down with an accountant and you understand the different implications, the tax implications that are involved with your real estate investing strategy. Now, regarding flipping, the CRA has come in and basically said that maybe the principal residence exemption wouldn't apply if you sell your principal residence in under 1 year. So a lot of people were buying a house, moving their family into the house, making substantial renovations to the house, and then selling it right away for a huge profit, which was sheltered by the principal residence exemption. So you really have to be careful. You have to make sure that you're holding on to the property for more than 1 year, that you could justify this, that you change your mailing address the second that you move in. And it really comes down to being able to show the intent that you weren't flipping the property. So it's you have to be careful about listing the property. You would better off getting an offer when the property is not listed. Um, and there's other considerations that I'd be happy to discuss with you if we had a little
Sure.
bit more time.
Yeah, so I understand there's exceptions in this rule. When you buy a piece of property because of circumstances, the CRA will waive that thing in case there's some sort of family background or some breakup or something. Can you please enlighten us on those ones?
Yes, I mean, I think that the exemptions aren't really what you should be aiming for because those happen to be life events. If you move into a house with your partner and then, the marriage doesn't work out and you get divorced and you have to sell the house, then in that case, the CRA will allow for the principal residence exemption to apply, but it's really not a good strategy to plan, on a life event, an unexpected life event to hit. You need to have a more thorough strategy before buying the property that aligns with the tax strategy.
You're right. Now, one more thing about flipping. There are two types of flippers. Some of flippings are doing simply by putting a piece of property under contract, assigning the contract before sale. So that's an assignment sale. A second flipper, they will buy a piece of property, run the property, fix it, and then they resell it within a short period of time. So what is the CRA have to do in that scenarios?
Well, in wholesaling, it's a different type of business, right? Where when you're generating revenue from assigning a contract. So that typically is viewed as business income, and it's very important to make sure you're structured for that before you start that type of business, right? So usually it's recommended to have uh, an operating company set up, a Canadian controlled corporation set up to conduct that business. That way you could benefit from the small business exemption, meaning that your tax rate on that type of income would be as low as 8 or 9% in Canada. Whereas if you just operate as a sole proprietor, you'll be taxed at your marginal rate, which is likely much, much higher. So it's important, again, to make sure that you're set up from the get-go and that you get advice from somebody that understands the industry so that you could be, set up for success.
So you brought two different points here. So when you're doing individually, it will be considered capital gain, and if you do it in a corporation, it'll be business income. Is that correct?
No, that's not correct. The distinction between business income and capital gain really is it really comes down to the intent. Like I was saying, um, if you're treating the property as inventory, meaning you're buying and selling multiple properties over the course of the year or over the course of several years, then the government will come in and probably look at that as business income. Whereas if you're more passively, moving into the house, moving your whole family into the house, spending years in the house, and then selling the house later down the line. In this case, it would be viewed as a capital gain. So it really is specific to every situation, but it does not matter. The classification of business income versus capital gains, it doesn't have anything to do with whether the property is in a corporation or not. But the tax implications of how much tax you'll pay, it's really important to distinguish between whether you're holding the property personally or if you're holding it in a corporation.
So in your case, in this case, intent to what you intend to do with the property will matter in the CRA, and CRA can figure it out. Hey, is it a business income or is it a capital gains?
That's right. Yeah.
Now, the tax laws are very complicated and it's very hard to follow all the compliances and so on. So, do you think it's a good idea for an investor that they should have a tax planning session with somebody like yourself before they jump in, or they just jump in and come back to you and say, okay, file my taxes. Now save me some taxes.
I think you probably definitely know the answer to that, Nav. I highly recommend at least getting some advice. We offer a free strategy call. You could go on our website and book a call to speak directly with me, and I'll give you some free advice on how to at least get yourself set up for success. But planning when it comes to taxes is really, really important. And like you said, like you're saying, it's a complex tax system. There's personal tax, corporate tax, GST, QST. And that, I don't really think that's for the entrepreneur to worry about. That's for me to worry about. So book a strategy session with us. We'll get you set up for success so that once the deal's done and the end of year has come, we'll be able to file your taxes in a way that reduces the overall taxes that you have to pay to the max.
One of the worst nightmare real estate investors have, the word is called audit.
Yeah.
And for me, the way I have been saying, hey, if you want to avoid the audit, have a tax planner with a CPA ahead of the time. Dig the well before you're thirsty. Plan ahead of the time,
That's
and
right.
let the CPA be here, take the responsibility to some degree. Audit can be called, but CPA can be ready ahead of the time, though.
Mm.
So, in your opinion, when the audit happens, is it a bit of a nightmare for the investors?
It can definitely be a nightmare. I've seen some nasty audits in the past, and oftentimes that's when clients come to me after they receive a letter from the CRA. Part of the strategy planning that we like to do is that we like to set our clients up for success, meaning that they'll be audit proof. And just some quick tips for the listeners out there. Um, you know, it's really, really important to maintain your documentation. I know that everybody says that, but you really want to have that shoebox of receipts available. You want to have a separate bank account for each investment property so that you could organize all the expenses on an investment property basis. Those are pretty key things that in general will really help you in the case of an audit. That will help me do the back work. and defend your position if you ever do get audited. But the most important thing when it comes to taxes and tax planning is to be proactive, get in front of the ball, make sure that you're organized, make sure that your books are clean, and work with an accountant that's specialized in the field so that your tax strategy and your accounting can align with your business strategy.
Or do you recommend that every investor should have a bookkeeper or bookkeeping services from firm like yours or so that can keep it up, and especially when it comes to interest payments? Are you paying interest on all those different services, though?
Yes, I mean, we do offer these services. Bookkeeping for me, my view on bookkeeping is that it should function like utilities. I don't want to bother the entrepreneur with any questions. We work in the background. We keep all of your books up to date and compliant. Of course, we do have certain questions that we may need help with, but it should function as utilities. When you need information, we have it at the tip of our fingers, and that everything is being filed on time. You know the payments that are upcoming that you have. So that's my view of bookkeeping services.
We're going to wrap up the session. Before we wrap up, I'd ask you to give the two top tips to the Canadian real estate investors that they should do every time. And even when, if they want to book a strategy call with you, please also give your name and phone number so they can call directly to book a appointment with you.
Yeah, absolutely. So in terms of the tips, I think it's like I've been saying, I think it's a recurring theme on this call. You need to get ahead of this. You just like you want to do your due diligence on every property that you acquire, you want to make sure that you're compliant with tax laws and that your tax strategy is aligned with your business strategy. So I think that anybody that's listening out there, they should hop on a call with somebody that's qualified, somebody that's ideally a specialist in the field so that they could really give value added to their accounting setup and to their tax planning. If anybody wants to book a call with me, they could reach me on my website. It's mogulcpa.com. So mogulcpa.com. There they'll be able to book a free strategy call with me. My calendar's there and they could find a time that suits them best. I usually find that that's the best way to work with clients, but I'll also make my direct line available to your audience, which is 514-294-3896. That's 514-294-3896.
One more question I forgot to ask. I believe you serve all across Canada and you also speak French.
That's correct. So we're based in Montreal, Quebec, La Belle Province, and I deal with Revenue Quebec all the time. But we service clients that are in real estate across the country, everywhere from BC to PEI, Nova Scotia. We handle all client files across all provinces and territories.
All right, thank you, Matthew. We're going to be doing another call pretty shortly. This is pretty lightning. Since the tax season is coming up, I expect that we're going to be doing another call within the next 30 to 60 days time, and we'll provide from there. Thank you so much for your time.
I'd love to be back on the show. Thank you, Nav.
Thanks, take care. You have a good day.